Good afternoon, boys and girls. It's the weekly economic update for Monday, December 20th, 2021. I hope everybody's had a fantastic weekend. It's pretty nice here on the Front Range. Pretty mild temperatures, but, still no, everyone's all wrapped up or worried about the lack of snow for Christmas. Oh, boo-hoo. I'm sure we'll get plenty of snow after the first of the year. So, plus, I think we're in a La Nina, and which creates a lot of dry air across this part of the country. So, it's just one of those things. No need to worry. Life will go on. I'm sure we'll have snow next year. Not a whole lot of crazy news today. I mean, the market was not ideal. I think a lot of people are losing their shit over the Omicron variant. But, the news out of South Africa was that this is, not nearly as deadly, I guess the word, and it seems to spread more rapidly. So in the end, if it's, not as harmful to people and it goes through the population quicker, maybe that's the end, hey, maybe we're there. So a couple of the people I listen to seem to think so. All righty. Well, let's go ahead and get into what's going on in the world. All right. The week on Wall Street, stock prices retreated last week as global central banks joined the Federal Reserve in taking steps to tighten monetary policy. The Dow Jones fell 1.68. The S&P 500 dropped 1.94. The NASDAQ tumbled 2.95. And international gained 0.47. So it looks like overseas did much better than here domestically. From uncertain to unsettled, stocks weakened ahead of Wednesday's FOMC meeting as investors weighed how aggressive the Fed might be in reversing its easy money policies. Investor sentiment was further dented by disappointing economic data. Retail sales fell short of expectations, and a year-over-year jump of 9.6% in producer prices reflected price pressures that may translate into higher future consumer prices. It was the highest percentage increase since a record started in 2010. Hang on a second. I got to clean my glasses. They got spots on them. Don't you hate when you got little dots of dust on your glasses and you can't see? It's just, Anyways. All right. Let's get back into it. The market initially responded well to the FOMC announcement on Wednesday afternoon, but became unsettled into Thursday and Friday over tighter monetary policy and Omicron concerns. A new Fed narrative. After the FOMC meeting, the Fed announced a plan to quicken the tapering of its monthly bond purchases. It planned to double the rate from $15 billion a month announced in November to $30 billion a month, effectively putting an end to asset purchases by March of 2022. The Fed also signaled that that as many as 3 rate hikes may be coming in 2022. The Fed cited elevated inflation and an improved labor market as justifications for the pivot from its pandemic-related easy money policies. Reflecting the persistence of higher than anticipated inflation, the Fed raised its previous inflation estimates for the year end 2022. Final note, our weekly market commentary will not be published next week. We want to take this opportunity to wish you and your family a wonderful holiday season and a very happy and prosperous new year. Yeah, Christmas is on Saturday. Hey. So I'll be back on Monday. Next Monday, I'm going to be driving to New Mexico during the day. So the weekly update may be a little later in the afternoon. So I do apologize if anyone is upset by that. So, all right, we have some economic data coming out this week on Monday, which is today, the index of leading economic indicators and the FOMC announcement. Wednesday, we have GDP and consumer confidence and existing home sales. Thursday, durable goods orders, jobless claims, new home sales, and consumer sentiment. There's a few companies reporting earnings this week, Micron and Nike today. Tomorrow is General Mills, and Wednesday is Cintas and Paychex. All right, well, that's everything for the weekly update. I did have one white paper going out this week. It is titled IRA Deadlines Are Approaching. All right, so let's blaze through this. I think we probably covered a lot of this over the last few months, but just for anyone who hasn't taken care of their RMDs or their contributions to their retirement plans, now's the time to pay attention to this. Financially, many of us Many of us associate the spring with taxes, but we should also associate December with important IRA deadlines. This year, like 2021, we see a few changes and distinctions. December 31st, 2022 is the deadline to make your required distribution from certain individual retirement accounts. That should probably be 2021. Whoever typed that made a mistake. April 15th of 2022 is the deadline for making 2021 annual contributions to a traditional IRA, Roth IRA, or certain other retirement accounts. This extension from the traditional April 15th deadline follows an extension of other traditional tax deadlines. Some people may not realize that they can make their IRA contribution. You can make a yearly IRA contribution between January 1 and the current year and April 15th of the next year. Accordingly, you can make your IRA contribution for 2021 anytime between January 1st, 2022 up to April 15th of 2023. So these are very confusing. A person can open and contribute to a traditional IRA past age 70 and a half as long as they have taxable income. So that's good. Used to in the past, you couldn't put money into it. If you're making a 2022 IRA contribution in early 2023, you must tell the investment company hosting the IRA for which you are contributing. If you fail to indicate the tax year the contribution applies to, the custodian may make the default assumption that it's for the current tax year. Duh. All right. So just some tax deadlines. Let's see how the major indexes did today. Here in the U.S., the Dow was down 1.23, the S&P down 1.14, NASDAQ down 1.24. So they're all down about 1.25-ish. Small cap down 1.5. The VIX, the volatility index, surged 6% today, up to 22.87, got up to as high as 27.39. Again, 30 is kind of the number we look at is kind of the danger zone. So the closer we get to that, and it happens pretty quick. So, I mean, it can go from 20 to 30 within a few days. All right. Across Europe, I see a lot of red right here. And same thing in Asia. So it looks like for December 20th across the board, it looks like most of the equity markets were down. All right, I got a couple articles I wanted to share. This first one is with Biden's spending plan blocked, economists cut 2022 growth forecasts. So for anyone who was, living under a rock the last 3 days, Senator Joe Manchin from West Virginia decided that he is not going to support this bill for the Build Back Better plan. Thank goodness, there's no more money to steal from the taxpayer. I guess unless you ask, somebody on the left, they would say, hey, there's more. I mean, let's tax 90%. Why not? Y'all don't need to live on, buy food or anything. All right. Let's go ahead and get into this. This was written by Jonelle Marte of Reuters. Some economists expect the U.S. economy to grow more slowly next year after a key Democratic lawmakers dealt a seemingly fatal blow to President Joe Biden's $1.75 trillion spending plan, further clouding an outlook that was facing heightened risk from rapid spread of Omicron variant of COVID-19. I mean, let me stop here. What does the spending bill have to do with anything with the economy, quite honestly? I mean, because you're robbing the taxpayer to launder it through the government to then pay wages to people that you probably could have just, in a free market, we could have hired those people to do that stuff anyways. I don't know why we have to launder it through the government. All right, let's get back to it. Goldman Sachs lowered its GDP forecast, as did Mark Zandi, chief economist of Moody's, after U.S. Senator Joe Manchin said on Sunday he could not support Biden's ambitious Build Back Better proposal, which would expand the social safety net and tackle climate change. Again, two things that are not within the scope of the federal government. I don't know why people don't get that. I mean, do I need to come out, and slap you in the side of the head and make you read Article 1, Section A of the Constitution? I mean, it's not very long. I don't know why people seem to think that just because the idiots in Washington vote on it, that we have to implement it. If BBB doesn't become law, the economic recovery will be vulnerable to stalling out if we suffer another serious wave of the pandemic. I doubt that's going to happen. An increasingly likely scenario with Omicron spreading rapidly, Zandy wrote on Twitter on Monday, adding that he expects real GDP growth to be lower by half a percentage point in 2022 if the proposed legislation doesn't become law. Whew, half a percentage point. Oh my God. What will we ever do without those 50 bips coming from the government? Democrats are absorbing the legislative setback as Biden administration faces criticism from health experts amid a surge in COVID. Whatever. One shift that economists say could slow growth is the reduction of enhanced tax credits that sent family monthly payments of up to $300 per child, but which is set to expire December 31st. Boo-hoo! I should not be paying to feed your kid. Lawmakers could pass a modified version of Biden's spending bill next year or decide to extend the credit retroactively, although negotiations could take weeks, Goldman Sachs researchers wrote in a note to clients. U.S. economic output was expected to slow in the early part of next year from a brisk pace seen at the end of 2021, even before Omicron emerged as a threat to global growth, and Biden's spending plan was derailed. Economists projected earlier this month that growth would slow next year as the lift provided by earlier spending programs faded and the Federal Reserve reduced its monetary policy accommodation in the face of higher inflation. The annualized rate of gross domestic product growth was expected to drop to 4% in the first quarter of 2022 from an expected 6% in the final 3 months of this year, according to Reuters poll of economists published on December 8th. Growth for all of 2022 was seen decelerating to 3.9%, still well above pre-pandemic trends from 5.6% this year. The Fed announced last week that it would double its pace of bond. Yeah, we already talked about that. So, all right. So I see this as a good thing. The republic is on the verge of collapse. The dollar is, in a real precarious situation. And some people are just worried about spending more money on the lazy. So, you know what? The lazy should get off their ass and go get jobs and be productive. End of story. All righty. Next article. This comes from David Stockman, The Truth About the Stock Market and What It Means for You. David Stockman is someone I have a lot of respect for. I don't agree with everything he says, but I certainly value his input. So let's go ahead and read through this real quick. See, I've only been rambling for 12 minutes, so I'm doing good today. The fundamental consequence of 30 years of Fed-fueled financial asset inflation is that prices of stocks and bonds have way overshot the mark. That's why what lies ahead is a long stretch of losses and investor disappointment as the fat years give way to the lean. These will hit hard with the bullish investor herd and aggressive buyers of calls who can't imagine any other state of play. They will be shocked to learn, but only after it's way too late, that the only money to be made during the decades ahead is in the short side of the market by buying puts on any of the big averages, the FANGman, S&P 500, NASDAQ 100, and the Dow, and any number of broad-based ETFs. The reason is straightforward. The sluggish, debt-ridden Main Street economy has been overcapitalized and will take years for company profits and incomes being generated to catch up to the currently bloated asset values. Accordingly, even as operating profits struggle to grow, valuation multiples will contract for years to come, owing to steadily rising and normalizing interest rates. We can benchmark this impending grand reversal on Wall Street by reaching back to a cycle that began in mid-1987, that's when Alan Greenspan took the helm of the Fed and promptly inaugurated the present era of financial repression and stock market coddling that he was pleased to call the wealth effects policy. At the time, the trailing PE multiple of the S&P 500 was about 12x earnings, a valuation level that reflected a Main Street economy and Wall Street financial markets that were each reasonably healthy. The U.S. GDP in Q2 1987 stood at $4.8 trillion, and the total stock market was valued at $3 trillion, as measured by the Wilshire 5000. Back then, Wall Street stocks were stably capitalized at 62% of Main Street GDP. Over the next 34 years, a vast, unsustainable gulf opened between the Main Street economy and the Wall Street capitalization of publicly traded stocks. During that 3-decade period, the Wilshire 500 market cap rose by 1,440% to $46.3 trillion. That's nearly 4 times the 375% gain in nominal GDP to 22.7 trillion. Accordingly, the stock market, which has barely 3/5 of GDP on Greenspan's arrival at the Fed, now stands at an off-the-charts 204% of GDP. If we measure from that moment, the 1987 stock market capitalization rate rate against national income was roughly correct. That would mean that the Wilshire 500 should be worth 14 trillion today, not 46 trillion. Hence, the 32 trillion of excess stock market valuation hangs over the financial system like a sword of Damocles. In fact, we believe that the gulf between the GDP and the market cap has grown wider and more dangerous since the Fed sped up money printing after the Lehman meltdown. To wit, since the pre-crisis peak in October 2007, the market cap of the Wilshire 5000 is up by nearly 32 trillion, while the national income to support it, GDP, is higher by only 8 trillion. The stock market's capitalization should be falling, not soaring into the nosebleed section of history. After all, since the financial crisis and Great Recession, the capacity of the U.S. economy to generate growth and rising profits has sharply diminished. The real GDP growth rate since pre-crisis peak in Q4 2007, for instance, is just 1.5% per annum, which is less than half of the historical trend rate of growth. Back in October of 2007, the stock market's capitalization was 106% of GDP, and in just 14 years, it has soared to an aforementioned 204%. So even as the growth rate of the U.S. economy has been cut in half, the stock market capitalization has doubled. Given that the stock market has gotten way, way ahead of the economy, the longer range implication is a long spell during which financial asset prices will stagnate or even fall until they eventually recover the healthy relationship to national income. Looking at this from a different angle, the current 46 trillion market cap of the Wilshire 5000 would not return to 62% of GDP until the US GDP reaches $75 trillion. At an average of 3.3 per annum increase in nominal GDP since Q4, it would take 38 years to get there. Yeah. So if we believe that Mr. Stockman is correct, we are potentially heading into a situation where we're going to have stagnation, stagflation, pretty much the 70s, kind of reboot all over again, maybe for the next decade. So I don't know. I mean, I soak in information and then use that to make, command decisions for what happens here at my practice. So you do what you want to do. I'm just, sharing with you. All right. One more article. This comes from First Trust, Brian Westbury, their chief economist. Just another perspective on what's going on into next year. This is the 2022 moderate GDP and persistent inflation. All right. Hey, I'm only at 18 minutes. From the 30,000 feet, from 30,000 feet, the COVID lockdown and reopening played out pretty much like we thought. GDP collapsed in the first half of 2020, then exploded in the third quarter, followed by strong but erratic quarterly growth ever since. The fourth quarter data, which is released in January, will show 2021 had the fastest GDP growth, highest inflation since the 1980s. As a reminder, this is not a normal business cycle and shouldn't be treated like one. We have never locked down businesses. We have never seen such a rapid peacetime expansion of federal spending, and we have rarely seen such a huge increase in the M2 measure of money. Shutting down the economy destroys supply chains because they work best with a free flow of information, and paying people not to work after the economy is open makes it worse. Small businesses have suffered much more than large companies, so while profits and stock prices are at or near all-time highs, real GDP will still end 2021 lower than it would have if COVID had never happened. Meanwhile, inflation under COVID has been much higher than the pre-COVID trend. Normally, the government involvement in an economy does not alter its path so much from quarter to quarter or year to year. Sure, the Fed rate hikes or tax rate changes must be accounted for, but the massive nature of government interference in the economy since March of 2020 has made us all Keynesians now. factoring how much spending is borrowed from the future, how much new money the Fed is printing, and whether tax rates will become more punitive is all part of any forecast. For example, some of our economic peers are now saying 2022 growth will be slower than it otherwise would have been because Joe Manchin has said no on the Build Back Better plan. Their forecast argues that fewer government handouts will reduce spending and therefore GDP growth. We think that is simplistic analysis. Yes, fewer handouts will lead to reduction in deficit spending. However, with 11 million jobs open or job openings, it will likely lead to more actual employment. So any slower growth from less government spending will be offset by more growth from the private sector, which will help supply chains. At the same time, without BBB, tax rates will not rise, which is positive for longer-term growth. Putting it all together, we expect real GDP to be about 3%, a 3% rate in 2022. Why slower than 2021? Because 2021 was artificially boosted by big deficit spending. Why not slower than 3%? Because small businesses will bounce back and the BBB tax hikes and distortionary spending are now less likely. For inflation, it looks like the consumer price index will be up in the 6.5 to 7% range this year. The consensus among economists is that it will slow to 2.7% next year, but we think inflation will run 4% or more. On the granular level, look for rental price of housing, which makes up more than 30% of the CPI, to be a key driver of inflation for the next few years. In addition, we expect oil prices to move higher again as regulatory ambiguity related to environmental rules curbs exploration. For the job market, look for a solid job growth to continue. Job openings remain plentiful. And slowly but surely, some of the people who have left the labor market should get pulled back in by rising wages. Look for about another 325,000 to 350 jobs per month next year. Don't get too excited, though, at that pace. At the end of 2022, we will be barely 700,000 jobs above the pre-COVID level. Not impressive for a time period of almost 3 years. Yes, the unemployment rate should get down to the 3.5% the Federal Reserve expects by the end of 2022, equaling the pre-COVID rate, but it will be with much lower labor force participation. So 3.5% is not so impressive as it sounds. Put it all together, and we have an inflation problem that is obviously not transitory, and economic growth that's a glass half full. Good growth versus historical measures, but not yet enough to get us back to where we were if COVID had never happened. So. All right. Oh, I didn't put that on the screen. I apologize. Here was the article. So if you want to see it, my bad. So, all right. So that's everything. It's kind of a mixed bag. Some people think the world's going to hell next year. Others think it's, rosy. Those who thought that the spending bill is going to solve all their problems. I have a news flash for you. The government doesn't solve any problems. All they do is make it worse. They're the kind of, the government is, the government breaks your leg and then hands you a crutch or charges you for the crutch that they're going to hand you. So, and then another thing I heard over the weekend was any proposed legislation that requires robbing your fellow Americans to pay for it, it's a stupid idea. So if it requires taxing me or taxing your neighbors to pay for free college or free health care or whatever dumb thing you think is important, if it costs me money, it's a stupid idea. So use that as your baseline. So, if a new law, it doesn't cost anybody any money and it doesn't infringe on anyone's rights, hey, let's consider it. But if it's going to cost people money who don't agree with it, sorry, too bad. You can't force people to do things against their will. All righty. Well, that's everything I had for today. We're at a whopping 24 minutes, so I'll go ahead and wrap things up here. So if anyone needs anything from me, don't hesitate to reach out. Be sure to like, subscribe, and share with friends and family. And I will be back tomorrow with Liberty Call. I will be a little late. I have an eye doctor appointment to get my eyes checked and see if my prescription has changed over the last year. So it'll probably be about about 3:30, 4 o'clock before I get to it Mountain Time. So be a little later in the day. But just keep your eyes peeled. All right. Well, everyone have a fantastic week. We're leading up to Christmas. Be good. Santa's watching. So I'll be back tomorrow. Bye-bye.